Everyone's chasing the same handful of US tech stocks, hoping for those massive returns. But what if the real secret to 5-timing your portfolio by 2026 isn't hiding in Silicon Valley? I'm building a high-growth portfolio that combines a dominant US tech giant with 2 overlooked stocks, one from Brazil and one from Canada, that could be the key to unlocking some serious gains. In this video, I'll break down all 3. Finding true growth in today's market can feel impossible. It seems like every time you spot a promising company, its valuation is already astronomical, or thousands of other investors have piled in, squeezing out any real chance for explosive returns. The fear of missing out is real, but so is the risk of buying at the top. That's why I've been hunting for a different angle. Instead of just chasing the hottest US names, I'm building a portfolio engineered for both growth and resilience. The strategy is simple: anchor it with a best-in-class tech leader, fuel it with an undervalued emerging market opportunity, and stabilize it with a reliable dividend-paying stalwart from a different country. This isn't about just picking 3 random stocks. It's about a specific combination of assets that I believe work together to create a powerful engine for growth, with a speculative but clear path to multiplying your investment by 2026. Let's get into the first pick. Section 1, the US tech anchor, NVIDIA. Our first stock is the anchor of the portfolio, and it's a name you definitely know, NVIDIA. Now you're probably thinking, NVIDIA, that's not exactly a hidden gem, and you're right, it's the king of artificial intelligence, and its incredible run has been making headlines for years. As of late 2025, the stock has surged 50% this year alone, and the company is nearing an incredible $5 trillion market valuation. But this isn't about chasing past performance, it's about securing a piece of the biggest technological shift of our generation. The investment case for NVIDIA is simple. It's the picks and shovels provider for the AI gold rush. Every major tech company, from giants like Microsoft and Google to thousands of AI startups, relies on NVIDIA's GPUs. The company commands an estimated 80% of the AI chip market, creating a near monopoly on the hardware that powers this revolution. This isn't just a trend, it's a fundamental rewiring of the world's computing infrastructure, and NVIDIA is at the heart of it. The numbers are wild. Some analysts project that spending on AI accelerators will swell to around $330 billion by 2026. NVIDIA is poised to capture the lion's share of that. In fact, some projections suggest NVIDIA's data center revenue could approach $253 billion in 2026. Just recently, analysts noted that the company has potentially booked a mind-boggling $500 billion orders for its AI processors. This isn't just speculative demand, these are signs of a massive, established growth trajectory. But here's why NVIDIA is the perfect anchor and not the whole strategy. The biggest risk is its valuation. A stock that has run this far, this fast, is always at risk of a pullback. Any hint of a slowdown in AI spending could cause a shakeup. That's exactly why we don't go all in. We use its unmatched growth potential as the portfolio's engine, but we hedge it with assets that have totally different risk profiles. NVIDIA provides the explosive power, but it needs balance. Section 2, the Brazilian growth engine, Ultrapar Participações. This is where our strategy veers off the beaten path. Our second stock is Ultrapar Participações, ticker UGP. This is a heavyweight in Brazil's energy distribution sector, and it's the kind of overlooked opportunity that can supercharge a portfolio. While everyone is staring at AI, we're looking at the essential infrastructure of South America's largest economy. Ultrapar is deeply woven into the fabric of Brazilian life. Through its subsidiary Ipiranga, it's one of the largest fuel distributors in the country. Through Ultragaz, it's a leader in liquefied petroleum gas, LPG, for homes and businesses. It also operates in liquid bulk storage and specialty chemicals. Simply put, this company is a direct bet on Brazil's economic pulse. So, why Ultrapar, and why now? The company is showing strong signs of momentum that the market seems to be ignoring. It carries a buy, or strong buy, rating from majority of analysts, and earnings estimates have been climbing. Plus, it pays a healthy dividend, giving you some income while the growth story unfolds. But the real thesis here is a mix of value and macroeconomic recovery. Brazil's economy is showing signs of stabilization, while GDP growth is expected to be modest, in the 1.5% to 2.4% range for 2026, inflation is projected to ease. This could set the stage for interest rate cuts, creating a perfect environment for a company like Ultrapar, which thrives on increased transportation and consumer activity. Now let's be real about the risk. Investing in Brazil, the country has a history of political and currency instability, and those are valid concerns. However, Ultrapar's essential role in the energy sector gives it a defensive moat. People and businesses always need fuel, making its revenue more resilient than a flashy tech company during a downturn. This is our high-octane diversifier. While Nvidia is a bet on a global tech trend, Ultrapar is a calculated bet on a regional economic turnaround. Analyst price targets suggest a solid upside, but the real, speculative thrill lies in the long-term recovery of the Brazilian market. Section 3. The Canadian Stabilizer, Royal Bank of Canada. We've got our US tech engine and our Brazilian growth catalyst. Now, we need the stabilizer, a stock that brings income, stability and resilience to the portfolio. For that, we head north to the cornerstone of the Canadian economy, the Royal Bank of Canada, ticker RY. Let's be clear, Royal Bank of Canada is not going to 5x on its own. Its job in this portfolio is completely different. It's the bedrock. As Canada's largest bank, it's a financial giant with operations in banking, wealth management, and capital markets. Canadian banks are famous worldwide for their stability, having navigated financial crises much better than their peers. That makes RY an incredibly reliable long-term hold. The play here isn't explosive growth but steady compounding and risk management. RY offers a healthy, growing dividend. That provides a consistent cash flow that you can reinvest or use as a cushion during market dips. And this dividend is dependable. Canadian banks have a long and proud history of paying their shareholders. Think of it this way, Nvidia is the sail catching the powerful winds of the AI revolution, Ultrapar is the turbocharger, ready to kick in with high torque power, and Royal Bank of Canada is the keel, deep, stable, and keeping the whole ship upright no matter how choppy the waters get. The 5x portfolio thesis. So, how could this combination possibly lead to a 5x return by 2026? This isn't a guarantee, it's a look at a high-growth, speculative scenario built on synergy. Let's do some ambitious back-of-the-napkin math. To 5x the portfolio, we need a massive average return across these three stocks. This is where the balance is key. Nvidia is our powerhouse. Given its market dominance and the sheer scale of the AI build-out, some analysts believe the stock has plenty of room to run as its massive earnings growth continues. A 3x or 4x from current levels by 2026 is an aggressive but not impossible scenario for a stock like this. Ultrapar is our asymmetric bet. Because it's an under-the-radar emerging market stock, it has the potential for the most explosive percentage gains. If Brazil's economy really takes off, a stock like this has the potential for multi-bagger returns. This is our home run swing. Royal Bank of Canada is our foundation. It might only deliver a modest total return over the next couple of years through its share price and dividends, but its stability is what allows us to take on the calculated risks of the other two. It helps prevent a single market downturn from wrecking the entire portfolio. So, there you have it. The three stocks I'm combining to target a high-growth return by 2026, the US tech anchor, Nvidia, the Brazilian growth engine, Ultrapar, and the Canadian stabilizer, Royal Bank of Canada. This isn't just a random list, it's a strategic portfolio designed for this specific market. It balances the incredible momentum of AI with unique, overlooked international opportunities. If you want more unique stock ideas and portfolio strategies like this one, make sure to subscribe and hit that notification bell so you don't miss the next video. And let me know in the comments below, what are some of the hidden gems you're watching right now? I'd love to hear your thoughts.